Welcome back. Now, despite challenging conditions, a more favorable securities market has served PSG Financial Services well during its half year. The group boasts a 21% rise in recurring headline earnings per share, and shareholders are being rewarded with a dividend increase of 18%. The man behind the purse strings, company CFO Mike Smith, joins us with his take on the performance. Mike, thanks so much for your time this afternoon. The group starting the new financial year on a high double-digit earnings growth. As we get started, just walk us through some of the drivers of growth. I did mention a favorable equities market also boosting the company.
Thank you. So what was pleasing during this period is that all three business divisions performed well. If I look at wealth, one of their key drivers was being able to bring in 11.8 billion of positive net flows, which constitute roughly 51% of the total inflows in the unit trust industry during that period. And we also had positive market performance. So that business fees are earned really on the value of our assets under management, delivering good investment outcomes for clients and positive net flows. If I look at the asset management business, their headline earnings were up 25% during the period. Benefited from the favorable equity markets and also inflows of about just under R1 billion there, as well as performance fees. Then if I look at Insure, we had very good loss claim ratios, underwriting margin of 15.2%, no catastrophe events, and also good growth in our gross written premium. So really, it was largely with our continued focus on execution, positive new business flows, and top line growth, which translated to the good results. And we have invested substantially over a long period of time, building and improving our systems and infrastructure, which enabled us to execute well.
And just on what we've been seeing in equity markets, it's been a great year for the JSE alone, but we've also seen international markets, your US markets hitting record high after record high as well, and also that working in your benefit, of course. Talk to us about how the business has been just navigating the more favorable market environment when it comes to returns and where you're seeing more interest from your clients. Are we seeing a more diversified portfolio, or are we seeing more interest when it comes to the JSE just on the back of what we've been seeing in the JSE?
Yeah, so our clients continue to be well diversified, both locally and offshore and across the full spectrum of asset classes to deliver the investment journey that they're looking for within their risk tolerance. So also what happened during the period, the Rand actually was strengthened a bit. So there, and that's why it shows it's useful to have a range of different assets. The JSE, a big portion of the positive performance was linked to the results of our gold mining and those type of shares there. So that's why you can sometimes get a small percentage of shares that make a large percentage of the overall returns. And I think one's seen similar in the international market. So, so it's really a consistent type of investment process that you provide an investment journey where clients are going to stay invested through the cycle. That's really been, I think, our recipe to success, that it's within the client's risk appetite and tolerance, and you deliver to the positive investment outcomes and that confidence that you bring.
Another lever that contributes to your success is how the group also prioritizes organic growth, right? But with so much cash on hand, how are you balancing organic growth with appetite for acquisitions?
So what we've done is also appoint a lot of new staff. We highlight in the results, we brought in 73 new graduates and that. So we like to go and develop our own talent, build them in the business. And we've invested in the past 10 years, 3 billion rand in IT infrastructure and systems. So we continue to invest in the long term, and all of the costs of our IT systems have been fully expensed as well. So it's really looking at your long-term sort of growth and the opportunity in the market and being willing to invest And with a lot of these projects, they're long-term, probably 2 to 3 years. So you need to look out and continue to invest throughout the cycles and roll out that incremental improvement that one's done, which has allowed you to get economies of scale, better efficiency, and enhanced overall service offering, which has improved the results.
And something else you've really been spending on is on tech advancement. Technology spend increased by 15% over the period. What are the main areas of tech, and how are these improving efficiency as well as client experiences?
Yeah. So invested substantially in our platform business on the wealth side. Breaking it down both into epics and features, and yeah, so it's been enhancing really the underlying systems to improve the operational efficiencies, to be able to take on the additional capacity as one's grown. And we'll be rolling out further improvements towards the second half of the year. So it's doing it in bite-sized chunks where you can show continuous improvement in process, mapping out each of the underlying steps, and then making sure that you execute it and that you get adoption as well. Because really you can spend a lot on a project, but you're only successful if you see it's adopted and fully implemented. And that's why it's working closely with the end users, understanding what they want, which will make a difference, and executing and delivering that and following it all the way through to adoption has worked for us.
And before I let you go, Mike, how are you viewing the current macroeconomic environment as well as South Africa as a whole? I was going through your commentary in the results, and the group has described South Africa being at a crossroads, right? We are seeing a low growth environment. Yes, some of those structural reforms coming through, but they do seem to be somewhat slow and not yet filtering through into real economic growth and also addressing issues like unemployment.
Yeah, so I mean, one does have those headwinds, and I think a lot of policy uncertainty there, both locally and offshore. I think fortunately we got a relatively small market share, so by being very focused on where we've got our strengths, one's able to pick up market share during these different times there. But it is more difficult when you have a low growth environment, particularly on the insurance side. A lot of your increase in insurance premium is linked to the GDP type of growth and investment there. And really for affordability of some of the services when you have a low growth environment is one of the challenges one has. And that's why I think one needs to continuously innovate and improve your efficiency to deliver services and maintain and reduce your cost per unit. And that comes from scalability there. So really adding load to the lorry allows you to achieve positive growth from a bottom line perspective, with a focus on growing your top line as well.
All right, thanks so much for your time and sharing your insights with us, Mike. Now, that was Mike Smith, Chief Financial Officer of PSG Financial Services.